Greetings. In our series of shorter videos, I'm going to revisit a topic that I spoke about in this video over here about how the quantitative easing done by the central banks of the world, while it is necessary to offset technological deflation, as I often speak about and is a primary theme on this channel, the fact that they buy bonds and buy mortgage-backed securities as a form of printing money in order to make it look like they're not printing money has caused all sorts of other problems and distortions that are reaching a breaking point. And the more obvious and clean solution, which is to just send cash directly to people, which I have described in great detail how that can work and how that can result in a gradual phase out of income taxation, effectively moving the income tax burden from humans onto automation, can be done very cleanly. I described that in my Atom publication, which you should read. You can also refer to that via a video book in this playlist over here. So $17 trillion of bonds have negative interest rates. Negative interest rates. So everything is upside down. The borrower does not pay interest, the borrower collects interest. The lender does not collect interest, the lender pays interest. In that if you borrow money, you actually can make money because you have to give back not more than you borrowed, less than you borrowed. Negative interest rate. $17 trillion in general have a negative interest rate, and this has been a problem that has accumulated since the start of quantitative easing, which had to be done just to offset technological deflation. So we have this article over here from the Financial Times, and it's a pretty recent article, September 26, 2021, so a little over 3 months old. And you can read the article, but we'll scroll down to the charts. You can see here the amount of bonds, the principal amount of bonds that have a negative interest rate. $17 trillion is what I spoke about in that video that I did earlier. It hovers around 15, often as high as 18, sometimes below 15, but that is what it is. The surplus amount that is not going into negative interest rate bonds is now going into tech stocks, and that's why you've had a tremendous boom of so many tech companies becoming trillion-dollar plus companies, and a number of small-time tech companies getting to $100 billion before you've ever even heard about them. A lot of surplus money is even going into cryptocurrencies. So this distortion is quite crazy because central banks, being hyper-theoretical PhD economists who have no concept of how anything in the real world works or any awareness of finance in terms of the lives of real people, they don't find this odd that by buying up so many bonds as a mechanism to do their money printing, they have created a huge chunk of bonds that have negative interest rates across the world. Now, most of these are concentrated in 3 countries, Japan, Germany, and France. The United States still does not have any treasuries that have negative yields, but it is certainly going in that direction over time. But because the amount of money printing they have to do rises exponentially, but they cannot think in an enlightened sense of how to print more money in a more direct way, which is to say give cash directly to people, they keep buying bonds and hyper distorting only that market, thereby precluding a better diffusion of the quantitative easing that they have to do. Remember, I said at the start of this decade on January 1st, 2020, that while the 2010s decade had $23 trillion of money printing done, the 2020s will have $100 trillion of money printing done just because that is how much is needed under the atom thesis of what portion of the economy comprises of rapidly advancing technology. And so far, in the first 2 years that have elapsed since January 1st, 2020, the amount of QE done so far is about 11 or 12 trillion. So it's very much on track for that $100 trillion prediction that I gave. However, that $100 trillion prediction was based on doing printing in the very indirect way that they continue to do it, which has a low velocity of money. If they gave cash directly to people, then it would require only $50 trillion of money printing to offset all technological deflation because the velocity of money would be much higher. The same money would circulate twice as fast. Now, because central banks are buying these sovereign bonds to such an extraordinary degree as to push $17 trillion worth of them into negative interest rates, that gravitational pull is now affecting corporate debt. And that is even more crazy. So as we scroll down, and you should read this article as well, starting in 2016, so quite recently, remember quantitative easing began in earnest in 2009. So only in 2016 did the excess of money printing that caused sovereign debt, as in debt issued by countries, to have negative yields, started to pull into corporate debt now. So corporate debt that has negative yields is now over $1 trillion. It became over $1 trillion in 2019, got above 1.5 trillion, and now is hovering around 1.1, 1.2 trillion dollars. It's smaller than the amount in sovereign debt, of course, but the fact that corporate debt can have a negative yield is crazy. Remember, big corporations such as Apple, they issue debt in order to buy back more of their own shares and thereby increase earnings per share, concentrating their earnings across fewer shares. Now, in the past, they at least had to pay interest to issue that corporate debt. Now they actually make money on that corporate debt as well. The debt buyer is the one paying the interest, and the corporation, such as Apple, is the one receiving the interest. So they make money by increasing their earnings per share by doing more share buybacks, and they make money on the debt itself because the debt now has negative interest rates. This is crazy. How much more evidence do you need that quantitative easing money the world over should be in the form of cash sent directly to people? There should no longer be balance sheets or any pretense that this will be undone and reverted back, because they just keep having to do more and more. The US Federal Reserve is again trying to taper their quantitative easing, and they say that they're going to normalize their policy after that. And I describe the many conceptual fallacies in what they're doing in this video over here. But of course, they're not going to learn. These are all PhD economists. They're hyper theoretical. They have no ability to connect with the real world, and they only interact with other PhD economists. So their body of knowledge, such as it is a very closed system. And only after things go wrong for 2 or 3 years do they consider doing something different. And even then, they don't want to deviate from the textbooks that they memorized. And these are textbooks that were written about a century ago, or at best 50 or 60 years ago. If something is new in the field that PhD economists study, it is 50 or 60 years ago, remember. So a lot of what they know is not really economics, but just a lot of mumbo jumbo and woo-woo. But this is quite absurd. I mean, look at this. Starting from 2016, the amount of corporate debt that has a negative interest rate is well above $1 trillion and is trending upward. And this is, again, an exponential parabola, as we are seeing, because this is spillover from the quantitative easing being done in a way that it doesn't go to the right place. This is really quite profound, and it is blindingly obvious what needs to be done, but it's only blindingly obvious to people who understand multiple subjects, ranging from economics to finance to the accelerating rate of change to centuries of economic history and even biological and evolutionary history. Now, if you watch this channel, then I have videos on all of those subjects. But someone who has a PhD in economics can only refer back to their textbooks that had frozen certain assumptions in time, and they have no chance of figuring this out at all. So this is going to get more and more distorted and more insane as well. And you have entire hedge funds that are trying to front run these central banks just by taking advantage of these ridiculous distortions. So they make money by betting on how slowly the PhD economists can learn something and how pig-headedly stubborn they will be before they give up on the textbooks that they have memorized. It's crazy, in fact. The most obvious solution: send cash directly to people and start lowering income tax, because the central bank printing funds government operations is something that market forces will force human society to undertake by the 2030s. Of course, there's going to be a lot of pain in between, just because these PhD economists are giving heads of state and other people who run society completely wrong advice. And such as it is, if someone has a PhD from Harvard, MIT, or Stanford, one would think they know the most about economics, but as I often say, no, that is proof that they actually receive the least amount of contrarian questioning, therefore never have cause to question their beliefs. And we know how that goes, the ivory tower syndrome. Anyway, I hope this video was informative in terms of giving you some food for thought about how even corporate debt now has negative yields, and the amount of negative yields in corporate debt is rising exponentially. What happens in 2023, 2024? This is exponential. This is going to come to a head pretty soon. The solution is extremely obvious, and the solution is very uplifting. It will be a dramatic improvement of the human condition. But alas, PhD economists stand in the way. They stand in the way of your prosperity and your elevation to a higher level. Keep that in mind. Thanks for watching.